Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Hello, in today's video we'll be taking a look at the October 23rd, 2025 trading session for the CBOE SPX index, and we will be trading 0 DTE options on the SPX index utilizing the Day Trading GPS Daily Key Levels indicator, specifically the V2.0 version of the indicator, which is the newest version just released a few weeks ago. Okay, so some of you may already be familiar with how this indicator works, but some of you may be new to the channel and new to our videos, so I will run through how the indicator works before we get into the rest of today's full session. Okay, so this indicator works on two different SPX symbols. One is the symbol that you see the chart on right now, which is the CBOE SPX index. So on your trading view, you would go into the symbol search and look for SPX, and then you specifically go to the SPX symbol that is under the CBOE exchange. That is your official CBOE SPX index. The other symbol that this indicator works on is the SPX 500 Forex CFD on the 8-cap exchange. So we'll look at that chart real quick. Okay, so here is today's chart of the SPX 500 8-cap. So on TradingView, this would be under symbol search SPX 500, and then you look for the SPX 500 symbol under the 8-cap exchange. The reason, there's a couple of reasons why it also works on this particular symbol. One of which is this is the way that you can get the levels for the CBOE SPX main official index 30 minutes before it opens at 9:30 a.m. Eastern New York time. The way TradingView PineScript works is even if your indicator already knows what levels are going to be for today's session before market open, such as in this case at 9 a.m., which is 30 minutes before the market open, the indicator already knows what the levels will be for the CBOE SPX index. However, when you have your chart on CBOE SPX, because it does not open until 9:30, it's not able to display the levels on the CBOE SPX chart until the first tick at exactly 9:30. So when you have it on the CBOE SPX symbol, you have the indicator on that chart symbol, you will see the levels for that at 9:30, and they will be the same levels that you see here in this second table, that if you have a second chart open on the SPX 500, you will be able to see the same levels here via the second chart at 9 a.m. Now the levels, while you have it on this SPX 500 that are shown here, are specifically for this Forex CFD here in this table. That's the same levels here, and then these levels are the levels for the CBOE SPX index, which opens up at 9:30. Since this CFD trades in the overnight and pre-market, then we're able to display the CBOE SPX levels on this chart. So this enables you to get a 30-minute jump on the CBOE SPX session. So if you trade SPX index options, then you want to have your chart on the CBOE SPX symbol. If, though, you happen to trade through a Forex broker and you're not trading SPX options, then you can use this indicator to trade through SPX through a Forex CFD through your Forex broker by using these levels through your Forex broker on the SPX symbol in that case. Another reason would be for using the symbols if you're taking a trading challenge with somebody like FTMO or Apex or one of the many other Forex brokers that offer trading challenges, in which if you pass their challenge, then you may qualify for one of their funded accounts. Those are primarily typically for trading Forex currency pairs and Forex CFDs on indexes and metals, etc. So that would be another reason that you could utilize it on this particular symbol. Okay, so now we're back on the CBOE SPX chart. The majority of people that use this indicator do use it for trading CBOE SPX index options. We have some people that do trade it for the Forex, but the majority do use it for the CBOE index, for trading CBOE index options. Okay, so while you have your chart on the CBOE SPX symbol, and at 9:30 a.m. Eastern New York time each day that the SPX market is open, you will get the new freshly updated levels on your chart for CBOE SPX. The most important level that you have, the most important key level that the indicator gives you for the session is this level here, the SPX Bull Bear KPL, which stands for key price level. We also refer to it in our videos as the BBKPL, and which, as you can see here in some of the other levels, it's also referred to as the BBKPL. So what this is the important bull bear pivot for this session. So after analyzing recent price action as well as overnight and pre-market action in the ES futures, as well as market dynamics and volatility and recent price action in the SPX CBOE market itself, the indicator has several proprietary algorithms which will generate the bull bear key price level for today's session, as well as the other key levels that it also has above and below the bull bear KPL. So those would be the R1 through R6 levels above the bull bear KPL, as well as the S1 through S6 levels below the bull bear KPL. So with this indicator, you can make bullish or bearish trades off of any of the main levels. The main levels specifically are going to be the bull bear KPL, and then the R1 through R6 levels, as well as the S1 through S6 levels. Now, before I go further into the video, I want to direct you to the description of this video, the YouTube description. And in there, there'll be, you'll see a heading that says, here are the links and descriptions to the additional videos on different topics I mentioned in this video. And that will be several different videos, so that will cover different topics that we're not really going to go over in this particular video of this session. But they are important topics if you have an interest in this indicator that you want to see, and some of those videos would be as follows. So one is going to be the indicator features video, which also shows you how to set up the indicator, as well as all the different inputs in the user control panel that you can use to customize the indicator, as well as all the different features of the indicator. Another video is going to go over all of the default levels that are displayed and the default look on startup of the indicator, and our recommendations for what you do from the default look startup to be prepared for the session, the beginning of the session, as well as changing the start chart display from the default to your preference. Another video is going to discuss entering bullish and bearish trades off of any of the main R and S levels. So in today's video, our trades are going to be off the bull bear key price level. That is the way this particular session worked out, at least with our primary strategy. However, there are opportunities later on in the session, after the first usually the first 5 minutes to 20 minutes of the session, to take either bullish or bearish trades off of the other main R or S levels, and there will be a video in the description with a link to that, which goes over in more detail discussing entering bullish and bearish trades off any of the other main R and main S levels. Excuse me. And it will also discuss the two different types of entries that you can make with this particular indicator, the standard entry and also the conservative entry for taking trades off of either the BBKPL level or any of the main R and S levels. And it will go into detail discussing the differences between the standard entry and how to recognize it versus the requirements for the more conservative entry, which requires some more confirmations how to recognize it. There will also be a video, a link to a video that discusses the process of how to determine which strikes to consider on trades, no matter which level, that main level that you are taking your trade from, whether it's bullish or bearish trades, and one being the at the money option, and then there's always going to be two out of the money options to consider, and that video goes over the process of how you go about determining which are the at the money options as well as the two out of the money strikes that you could consider on any given main level that you're taking a bullish or bearish trade from. Okay. So as I was stating, the most important level, the bull bear KPL, which for today's session was 66.95.01. The main levels above the bull bear KPL and the main levels below the bull bear KPL. At the beginning of the session, when a lot of your trades, and 90 to 95% of the sessions, you're going to be given opportunities to get either a bullish or bearish signal that will be from the bull bear key price level, including the opening 930 candle. In about 90 to 95% of sessions, that will be the case, not only on the opening candle, but in, say, the first 15 minutes or so of the session until the session starts progressing to other levels. So the point I'm trying to make is that when you have trades that are derived and triggered off of bullish or bearish signals from the bull bear key price level, so that would be the level that you'd be taking the trade from, the R levels above act as take profit levels for bullish entries that are taken for bullish trades taken off the bull bear KPL level, and then the S levels below are going to be your take profit levels for bearish entries that are taken from signals, bearish entry signals from the bull bear KPL. And we'll get into how that works here in just a few minutes. You'll also see that there are midpoint levels between each of the main levels. So these levels are optional to turn on. The two midpoint levels that are turned on by default are the midpoint level above the bull bear KPL and the first midpoint level below the bull bear KPL. The other midpoint levels are optional to turn on, as you can see. So we have some of them turned on because of the way the session turned out today in a bullish fashion, as opposed to having them on down here, which we would if the session was instead bearish. So those are optional to turn on. The two that are on by default are the midpoint level above, the first one above the bull bear KPL and the first one below the bull bear KPL. The midpoint levels can also act as continuing gauges of momentum in the direction that you're trading as well. And depending on how far away they are from the level that you're trading, they can also act as waypoints for decision making, for either closing out your trade or for making a stop loss adjustment or for a scaling out. You'll also see here these QL levels, which are in white. The QL levels are optional to turn on above and below each of the main levels. By default, only the QL above the BBKPL and the QL below the BBKPL are turned on by default. You can turn them on other main levels above and below as well, depending on whether you would like to utilize them in trades off of other levels. Okay, so we'll get into how these QL levels and midpoint levels are utilized initially on bullish or bearish entries here. And but before we do that, we'll just explain a few other things about the indicator, one of which is these other levels that you see here, such as YDH, PMH, PML, YDC, and YDL. So what do these stand for? You also see a table down here which also has these levels as well. So YDH stands for yesterday's daily high, so that is specifically the CBOE SPX previous daily RTH session high. PMH would be the pre-market high for CBOE SPX. YDC would be yesterday's daily close, so that would be specifically the previous day's CBOE SPX RTH session close. The PML level is the pre-market low for CBOE SPX, and the YDL level is yesterday's daily low, specifically the previous day's CBOE SPX RTH session low. Now these levels are also considered key levels that can be especially important, especially when you see them in confluence with other levels, such as you see here in today's session with the PMH here at the R1 level, and you also have the YDC at the QL above BBKPL. You also have this PML level, which is very close to this mid BBKPL S1, and then you have this YDL level, which is very close to the S2 level. So these levels can also act as important waypoints for decision making as far as continuing momentum in a direction with closes above or closes below, successive closes below them. And they can also see, as we'll see in today's session, they can also be further utilized as waypoints for decision making for exits once a move has progressed to a certain point and has exceeded a certain minimum requirement point as far as a target exit. Then they can also come into play as far as additional points for an exit or for a scaling out or for a stop loss adjustment on a trade that is going in your favor. Finally, these two tables that you see here, these tables are adjustable in size. So right now we have them on the small size. You can also position them in many different positions on the chart depending on where you would like to have them. You can also turn them off if you feel like you would not like to have them and just save your chart real estate for other things. You can turn them off. As you see here, you do have the line labels for all of these as well. So they can be a little unnecessary. However, sometimes they can be useful, especially when you have your screen zoomed in and you're only looking at a certain number of specific levels. However, these tables can give you at least the reference if we start making a gigantic move in either direction on quick notice. Sometimes having these tables here can be helpful. They can also be helpful sometimes if there's some overlap in some of these levels where it may be a little more difficult to see the exact price. All of these line labels are adjustable in groups by size as well as the offset to the left or right of price action. So for example, the main levels, the bull bear KPL and the R1 through R6 and S1 through S6, I currently have set to the large text size. The midpoint levels are set to the normal text size. The previous day values and the pre-market values are set to normal, and then the QL line labels are set to small. You can individually control them as a group. So for example, you could change all the QLs to a different size and a different offset. If you'd like to, instead of seeing them in a straight row, you can change the offset on any particular group. So you could make the midpoint levels more to the left or right by themselves as a group. Same with the QL levels, same with the main levels, and same with the previous day and pre-market levels. So the offset to move them as a group either to the left or the right, more to the left or the right, as well as the size, and the same with all the other groups of uh, different lines as well. You can individually control them as a group either for size or for a offset to the left or right. And then also these tables, you can also control not only the position but the size, and you can also turn them off. Okay, so getting into today's session, we have the 9:30 a.m. candle marked off here. So you can see that this is a candle right here, and as you can see, we had where the candle did open above the bull bear key price level. It tried to travel down to the YDC level, and then it went all the way back up above the mid BBKPLR1, but it settled and closed below the BBKPLR1, but most importantly, it closed above the bull bear KPL. So this is a bullish entry signal if you want to take a trade off of the opening candle. As you see, we're on a 2-minute chart. If you watch our other videos, you'll see that all of our videos have the chart on a 2-minute chart. We have found that that is the best, most consistent result time frame for trading this particular strategy with this indicator, although alternatives to that would be somewhere between a 1-minute time frame and a 5-minute time frame if your preference is either something other than 2 minutes. You can also utilize it on either a 1-minute, 2-minute, 3-minute, or 5-minute. The indicator works on time frames of 1 minute to 30 minutes. This particular strategy is simply buying calls, options on bullish entry signals and buying put options on bearish entry signals. So this strategy does not involve, or at least the primary strategy for utilizing this indicator that we demonstrate in our YouTube channels, does not involve spreads, it does not involve butterflies or iron condors or other types of option combinations. It is simply buying puts on bearish entry signals and buying calls on bullish entry signals. However, there are people that do use this indicator for iron condors, for butterflies, and for other types of spreads and combination plays. And in those cases, you may want to consider a longer time frame if that is your preference for utilizing it for those particular types of strategies. You may find that a 10-minute, 15-minute, or 30-minute time frame works better for you with those strategies. However, our primary strategy is just what we outlined, which is buying puts on bearish entry signals and simply buying calls on bullish entry signals. Okay, so if you want to take this trade at the 9:30 open, keep in mind with this indicator, there's not a rule that you have to, or an obligation for this strategy that you have to take the 9:30 opening candle trade. We're explaining how you do that in this video, like we've done in most every video that we've made on here. However, there is no obligation or rule that says you have to take the first trade. Some people are not even at their desk trading at 9:30. They may be doing other things. And some people, frankly, just prefer to let the session breathe a little bit and get the opening moments out of the way, whether that's the first 5 minutes, 10 minutes, 15 minutes, 30 minutes, an hour, etc., and then they prefer to take trades off of whatever levels are relevant from the price action in that session at that time, whether at that time it's going to be one of the other main RRS levels, or if we do get other opportunities throughout the session with the bull bear KPL again. Okay, so on this 9:30 opening candle, we have a bullish entry signal because we have a close on the opening candle that is above the bull bear KPL. If instead we had a close of this candle that was below the bull bear KPL, and we wanted to take this 9:30 opening candle trade, then we would have a bearish entry signal. So the key is, where does this opening candle close? Now, there are some instances where you would not take a trade on the opening candle even though it closed above or below the bull bear KPL. These happen on a few occasions a year, where you will have a situation where the candle is going to open and close way outside of R1 on the upside, or way below S1 on the downside. So when you see something like that happen, that is too far out of range for taking a trade off the basing it on the bull bear key price level. And in those few instances that happen a year where something like that happens, then you are better off just passing on that trade, because it's too far away from the stop losses that you would use with the bull bear key price level, as we'll explain how you use the stop losses when you're taking a trade off that level. And instead, what you would do is, in that situation, we're looking at a gap and go, either a bullish gap and go extreme or a bearish gap and go extreme. And in those situations, you would want to wait, pass on the opening trade, and simply wait to see what price does after that. And then more than likely, you're going to be looking at a situation where you're making a decision to take either a bullish or bearish trade off one of the other main R or S levels. But in most cases, most of the opening candles, you are going to have the opportunity to take that trade, because they are going to be within the range of tolerance, as was the case today. Okay, so this close was above the bull bear key price level. Now, what are our strikes that we use on this particular bullish trade? So the process of figuring out which strike that you can use, or which strikes in general, there are 3 different strikes on any different level that you have for a bullish or bearish trade. So in this case, our trade is taken off the bull bear key price level. It's a bullish trade. So our standard play, or the standard option that you would consider for this, would be the at the money option that is closest in price to the level that we're trading. In this case, the level we're trading, the bull bear KPL. So since it's 66.95.01, that was going to be the 66.95 strike. And since this is a bullish entry signal, the 66.95 call. Specifically, the 0 DTE, 0 days to expiration, 66.95 call, which today is October 23rd, so it would be the 0 DTE call with an expiration date of today, 10/23. That means that it expires at the end of the session. Now, with this indicator, you can also use 1 DTE options. So if you were trading this today and your preference is to use 1 DTE over 0 DTE, then you'd be looking at the 1 DTE options, which would be the expiration for 10/24 when you're trading on 10/23. If you were trading on Friday and you wanted to use the 1 DTE options and the market was open on Monday, then you'd be using the Monday expirations if you were using 1 DTE. You'll see in our videos that we always use the 0 DTE. However, if you do want to use 1 DTE, you can take a look at the data boxes for these different options that are discussed today and see what your entry prices would have been on the same candles, and then what these options would have been at the different waypoints throughout the session where they are hitting different target levels. You don't want to use anything that is more than one DTE, because then you're paying too much for time premium. Because remember, with this particular indicator, this is a day trading indicator. You get new levels every trading day, and you are opening and closing your positions all in the same day. So if you start trading options that expire a week from now, you're just doing yourself a disservice, because you're paying a lot for time premium, which is not going to be relevant in today's session, because you're going to be opening and closing the option all in the same session. Okay, so the main play is going to be the at the money option at 66.95. If some of you are not familiar with how SPX options work, they trade in 5-point increments. So, for example, 66.90, 66.95, 6700, 6705, etc. So the closest one to this price is going to be the 66.95, and you're buying on the candle close. Why are you buying on the candle close and not just buying when it opens, since it opened above? Well, that's because we don't know if it's going to close above or below. So it's best to wait for the candle close to then make the buying decision, or the decision of whether you're going to be buying or entering the trade if you decide to enter it. Because this candle could have very well opened up here, cross below, and close below, and then you'd be looking at a bearish trade. So if you just bought it on the open, did not wait for the close, it ended up going down here and you're already stuck with a call, then you're doing yourself a disservice. So it's best to wait for confirmation with the close on the candle. So the buy price on this at the money call on the close of this 930 candle on the 2-minute chart, so that means it's closing at 932, was $22. So what that means, if you're not familiar with how options work, I'm sure a lot of you are, but for the few who may not understand how options work, you take the price of the option that you're paying, you multiply it times 100, and that's your cost for one option when you're buying options. So in the case of this, if it's $22, you multiply that times 100, so the cost of one 66.95 0 DTE SPX call is going to be $2,200. If you bought 2 of them, then it would cost you $4,400. If you bought 3 of them, it would be $6,600. If you bought 5 of them, it would be $11,000, etc. If the price was instead $10, then the price would be, you multiply that times 100, then the price would be $1,000. Okay, so what is the process of the 2 other strikes you can consider on this same trade? All right, so it works the same on any level that you're trading. First, is it bullish or bearish trade? Okay, it's a bullish trade in this case. If it's a bullish trade, then you look to the first midpoint above the main level you're trading. So in this case, we're trading from this level. We look up one midpoint above, and it's 67.0464. So the closest strike to that is going to be the 67.05 strike. The 67.05 call option strike, the buy price on that option on the close of this candle was $15.50. What's the furthest out of the money strike that you can consider? And that would be one that is one full level above, because this is a bullish trade. So one full level above from here is the R1 level, 67.1426. So that is going to be the 67.15 call is the closest to that price. So the 67.15 0 DTE call option on the close of this candle was $10.70. So as you can see here, this $10.70 price is a little bit less than half of what the cost would be for the at-the-money option. And this one is also significantly lower as well. So what's the downside of using the out-of-the-money options? Well, the upside is that they cost less, so you're going to have less money overall at risk in total, or less money debited from your account. But the downside, at least in the beginning stages of the trade, is you're going to make less money from the same move in the beginning stages of a trade. Later on, as a trade develops, if it starts going substantially in your favor, then they tend to move after a certain point. They start moving in lockstep with each other after it exceeds a certain amount away from the particular levels. However, in the beginning, as we'll see here in a second when we go over how each of these options perform versus each other, as you'll see, with the same move, you're going to earn less in the beginning with the out of the monies. But on the other hand, you have less money at risk and less money being debited. So you can look at it either as a percentage. You may be earning less dollar amount wise, but as a percentage of the cost of the option, you may in some cases be better off with an out of the money. Whether you use an out of the money or an at the money is really just a trader's choice, and that just comes from practicing with this indicator and deciding for yourself which is best for you depending on what levels you trade, what times of day you're taking your trades at, etc. Okay, so we have the three different options that we can consider here. The reason that you're not going to consider anything above this when you're trading from this level is it's just simply too far away. Yes, these would cost even less, but there's a lot more risk in having something that far away. And so that's why the process is that there's always going to be three different option choices, either at the money or two out of the money strikes. Just for clarification purposes, to help you understand, if instead this was a bearish trade and this had closed below and we were instead looking at bearish trades, then we'd have the same at the money option, but instead it would be a 66.95 put. Then our two out of the money strikes we could consider on a bearish play from this level. We would look to the first midpoint below, which would be the 66.85.39. So our first out of the money one we could consider would be the 66.85 put. And then the last one we could consider, the furthest out of the money, would be the one level away below on a bearish play, and 66.75.76. So the 66.75 put on a bearish play would be the furthest. And then it works the same on bullish or bearish plays off of the other levels as well, which is all explained plus more details in the video that I told you that was in the link to it in the description, which goes into more details on taking trades off of the other levels, as well as the two different kinds of trades, the standard and more conservative trade entries. Okay, so what about stop losses? Are the stop losses the same no matter whether you're using at the money or out of the money? Yes. The stop losses on your trade are going to be the same whether you're using an at the money option or an out or one of the two out of the money options. How you determine which stop loss to use is as follows. So on bullish trades off of any main level, including the bull bear key price level, your standard stop loss on bullish trades is going to be the first midpoint level below the level you're trading the bullish entry signal from. So in this case, this is your standard stop loss, the first midpoint level below the level we're trading, the bull bear KPL. So your standard stop loss is this level here. Your tight stop loss, if you prefer to use a tight stop loss, is the QL below on a bullish trade. the QL below the level that you're trading the bullish trade from. In this case, bull bear KPL. So our tight stop loss, if we prefer to use that, is the QL below the bull bear KPL. That also works the same in reverse. So if instead we were taking a bearish trade off of the bull bear KPL, our tight stop loss would be the QL above, and our standard stop loss in a bearish play on the bull bear KPL would be the first midpoint above. Okay, so no matter which you're using, the at the money or out of the money, it's the same stop loss. As you can see in today's session, neither one of these stop losses came close to being breached. That's not always the case. Usually your tight stop loss is going to be more prone to being stopped out than your standard stop loss. So we prefer to use the standard stop loss. However, there are many traders that would prefer to take the chance of more of a chance of getting stopped out and just re-enter their trade because they will have less overall at risk. So to start off with your initial trade, when you enter initially, your stop loss is going to be based on a level. So in this case, either this level for this particular trade, a bullish trade off of this level, either this level for the tight stop loss or this level for the standard stop loss. However, once the trade starts going in your favor and you reach, if you're doing a regular trade where you have the opportunity to, if you're not going to close out your trade, adjust your stop loss. When you're doing a stop loss adjustment at a profit target level on any remaining contracts you have, then at that time you're changing your stop loss to a number instead of a level. So at that time, which we'll get into in a second, so I don't want to get too far ahead of myself, but I just want to explain the difference. So initially, when you enter the trade, it's based on a level. However, when the trade starts progressing in your favor and you're reaching the point where you're making a stop loss adjustment, then you're adjusting it to break even, which is the cost that you paid for the particular option, or you're adjusting it to break even plus a profit buffer, which would be adding a specific amount on top of break even. Okay, so after you have entered the trade here, you have to decide what type of trade this is going to be. What is your target exit going to be? Specifically, are you scalping on this trade or are you doing a regular trade? So with this indicator, it's either you're scalping or you're doing what we call a regular trade. And there's a big difference between the two. So scalping only with this indicator, you are looking for a one level move in your favor, and then you are closing out 100% of your contracts, whether you're trading one contract, two contracts, three contracts, 5, 10, 20, or what have you. You're not doing any stop loss adjustment when it hits the target. You are simply closing out all of your contracts on that scalp. What do we mean by a one level move in your favor? So the way you determine what is a one level move in your favor is what is the level I'm trading from, in this case the bull bear KPL. What type of trade is it? Bullish trade. So I'm looking above on a bullish trade. What is the first main level above? What is one main level above? That's R1. So when price hits R1, then if you're only doing a scalp and that's your objective with the trade, then you are closing out 100% of your contracts. And that's what we have, what happened here on the 9:38 a.m. candle. So that happened on the high wick of this candle. As you can see, it touched it here, and here's the level here. As you can see, this also happens to coincide and have confluence with the pre-market high. So when it first gets up here, since the pre-market high is very near the R1, a lot of times you'll see, at least on the first attempt, you'll see where it may back off of the pre-market high. Sometimes it doesn't, but oftentimes it does. In this case today, it did in fact do that, but it did at least touch. It went through the pre-market high, which is 67.1371, and then touched and went slightly above the R1, 67.1426. So if you had your profit taking set to the price of the underlying touching a specific price, which you can do with some brokers, such as Thinkorswim, for example, offers that on both stop losses and take profits, where you can instead do a conditional order that's based on a touch of the price of the underlying, as opposed to your option reaching a specific price. Then that triggers the order, and then the order is set, and then you're out when it touches that particular price. So that is an option as far that you can do with both stop losses and take profit exits. With Thinkorswim, there are and we will have a link to that video. That's not a video that we made. There is a nice video that another gentleman made on YouTube, which will have the link to that in the description of this video as well. So if you're a Thinkorswim user, or you're thinking that you might give Thinkorswim a try, or at least their demo account a try, to try it out, then you can do that. Another broker that does that, that offers that, is Interactive Brokers. Interactive Brokers is a lot more cumbersome to use, a lot more, in my opinion, difficult to use, not very intuitive. Some people swear by it and love it. It does take a lot longer to get used to, so there is kind of a steep learning curve with it compared to, say, Thinkorswim. But that is another broker that offers that particular type of conditional orders. There may be other brokers that offer it. If they don't offer it, then if your broker doesn't offer it and you're not willing to switch brokers to one that does, then you just have to watch price action, and when you see price hit the particular level that you're looking at, then you would have to act and then manually close out your trade, or whether that is a take profit closeout, or hitting your stop loss. As I mentioned, Thinkorswim and Interactive Brokers do offer conditional orders for stop losses as well on options, based on the price of the underlying. If your broker does not offer that, and you're not willing to use one of the brokers that does, then you're going to have to just watch the chart and then stop yourself out should it hit the level that you are, at least on your initial stop loss, because that's based on the level. As I mentioned, once you start hitting your target exits, where you have a decision to make on whether you're going to adjust your stop loss, at that time, when it hits one of those levels on a regular trade, and you want to adjust your stop loss on any contracts, then you are instead going to just the standard price stop loss, which everyone has that on as far as brokers. Okay, so let's see how this worked out on this one level move here. So remember, this touch was on this wick here, not the close. So here, though, we've outlined both of them just so you can see the difference. That if you got out on the wick when it touched it, then the 66.95 call on the wick touch of R1 was 27.20, so that's a $520 profit per option. However, on the candle close, once it backed off, it went back down to 26, so that's only a $400 profit if you got out on the close per option. The 67.05 call on the wick touch was 20.20, that's $470 profit per option. On the candle close after backing off, it went down to 19, so that's 350 profit per option. The furthest out of the money, 67.15 call on the wick touch of R1, $14. That's $330 profit per option. And on the candle close after backing off, it went down to $13, which is $230 profit per option. Excuse me. We are going to take a quick look at the end of this video at the Thinkorswim data boxes for these different options. We'll just run through that real quick so you can see what the prices were on these different times that we've outlined here. Okay, so if you're scalping, you're out, and at that point you're flat on the session because you have 100% closed out all of your contracts, and then you're free not to trade the rest of the day if you don't want to, or you can simply look for another opportunity on one of the other levels. We're not going to go into what that might look like if you were out of this trade on a scalp and what your other trades may have been throughout the rest of the session. In one of our upcoming videos, we will go ahead and make a video that does go through that scenario. Today's scenario is just going to run through the regular trade to finality here. So if you want to subscribe to our channel, we will make at least one or several videos in the near future where we will do sessions where after a scalp, then we will just go through other scalping trades throughout the session on other levels. Okay, so a regular trade, if you may have seen some of our other videos, differs from a scalp in that a regular trade you're looking for an extended move. So you're looking for a minimum 1.5 level move as opposed to only a 1 level move in your favor. So you're looking for at least a minimum 1.5 level move in your favor, and then at that point, when it does reach that minimum 1.5 level move in your favor, then you have a couple of options as to what you would like to do with the options that you're holding. And we'll go over that now. As we can see now that so this happened at 9:38 where you're out of the scalp on that candle, and 10 minutes later it does hit the 1.5 level move here, which on a trade that's starting from the bull bear key price level, then that 1.5 levels is the mid R1 R2 level. So how you look at that is the trade is derived from this bull bear key price level. It's a bullish trade, so we're looking 1.5 levels above. So remember, the R1 is 1 level, the mid R1 R2 would be the 1.5 level, R2 would be 2 levels, and then mid R2 R3 would be 2.5 levels. Same thing in reverse. If it was a bearish trade, 1 level below would be S1, 1.5 would be mid S1, S2, and 2 levels below in a bearish trade would be S2. Okay, so as you can see here on this 9:48 candle, it does hit the mid R1, R2 level for a regular trade. So now we have our decision to make, either 100% closeout of all contracts or adjusting the stop loss on all contracts to break even, at least break even, which is going to be at least the price that you paid for the option, or break even plus a 10 to 15% cushion on top of that, meaning you're adding another 10% on top of the price that you paid on top of the break even. So in the case of the one option where that was $66.95, that was $22. 10% of $22 is $2.20. So if you wanted to make it to break even, you would adjust your stop loss to 22 at that time if you were inclined to adjust your stop loss instead of closing out, or you could adjust your stop loss to break even plus $2.20, which represents 10%, and then your adjusted stop loss with that 10% profit cushion would be $22 plus $2.20. That's $24.20 as an example. Your other option, and this is only comes into play if you're trading multiple contracts. If you're trading just one contract, then you only really have two options. One, either adjust your stop loss, or the other is just to close out the one contract. However, if you do have multiple contracts, specifically like 4 or more, this also could apply to 3 or more, but preferably 4 or more, then you could close out 70 to 90% of your contracts. So for example, if you had 5 contracts and you closed out 4, that would be 75%. Excuse me, 80%. If you had 4 contracts and you closed out 3, that would be 70%. If you had 3 and you closed out 2, that's roughly like 67%. So that's still roughly in the range. If you had 10 contracts and you closed out 7, then that would be 70%. If you had 10 contracts and closed out 9, that would be 90%, just to give you an idea. So the idea there is that if you're trading multiple contracts, then your third option is then that you can close out 70 to 90% of those contracts at the price that it is at when it hits the 1.5 level move, if you're so inclined, and then you would adjust your stop loss to break even, or break even plus a profit cushion as outlined on the remaining runners that you would have. And then what you're looking for is on the remaining runners is you are looking for a price to continue in the same direction. And if it doesn't continue in the same direction, then you're going to get stopped out. But if you have multiple contracts and you sold 70 to 90% of them for the full price here, when it hits this, if you're going to take action when it does hit the minimum required target, and remember, you're not required to take the action here. This is just the first point which you should make a decision on a regular trade. You could wait until it hits a 2-level move, or it hits YDH, or it hits a 2.5 level move, or a 3-level move, or even beyond, before you make that first decision. However, the most prudent thing to do is at least make an adjustment or take action of some kind at the minimum 1.5 level or the ideal 2-level move, and then let the rest of the session play out, primarily with any remaining runners that you may have on if you're trading multiple contracts. Okay, so in this case, the 66.95 call on the candle close here was 35.30. So that's $1,330 profit per option. The 67.05 on the candle close here is 27.20. That's $1,170 profit per option. The furthest out of the money, 67.15 on the candle close, is $19.72. So that's a $902 profit per option. Now remember, this furthest out of the money option, you pay $10.70. So on a percentage basis, this is actually doing better based on the initial cost than the at the money's one is doing. Because remember, the at the money was $22, and now it's up to $35.30. Whereas this is a little better as far as a percentage basis. So, you know, there's pros and cons of the at the money versus the out of the money. As you can see here on the scalp, the at the money worked out much better than the other ones. But like I said, there's pros and cons of each, and that's really just up for each trader to decide for themselves. Okay, so as you can see here, we did get a move back down to test the pre-market high again. It did move back down. However, the stop losses were never in as far as our initial stop losses. So if you did not do an adjustment here, then and you were just going with the initial stop losses that you had, those were never in jeopardy. If you did do an adjustment to break even, then there is a likelihood that you would have gotten stopped out on any remaining runners here on this move back down. Okay, so let's just go out through the rest of the session here. So as you can see, after making this flush move down here to shake out some weak hands, it then resumes its trudge upward, going above the pre-market high again, and then going above the R1. Now, just a quick note here, we will be coming out with another version of this indicator very soon that will also have the stop loss levels for the YDH, PMH, YDC, PML, and YDL levels also included. There'll be a couple of other features that I'm not going to talk about at the moment that will also be included in this other version that will be coming out soon, which will be known as version 3.0. Those that already have the indicator will be getting that new version for no additional charge, as all of our indicators are sold on a one payment for lifetime access basis. So the price of the indicator will also be going up at that time. So if you do have an inclination to perhaps purchase the indicator, as mentioned at the beginning of the video, you can email us at daytradinggps@gmail.com to request a promo code so you can buy it at the current price that it is, plus take the discount promo code off of that price, and then you will be able to get the newer updated version that'll have some more enhanced features when that actually does come out. But that version, one of the features it will have is trades off of those other levels as well. Okay, so as you can see here, after going back up, it then tests both the R1 and the PMH since they're so close to each other again, and then it does it again here, and then again here, and then finally it starts making its treads up to R2. And finally at 1242 it does hit R2, so that on a regular trade is a two-level move. So it's a two-level move that's calculated from where we originally took the trade, one level, 1.5 level, now two levels. So here you have another decision to make if you're still in the trade, and at this point you're making the same decision that or you at least have the same array of decisions that you could have made here. And remember, as we talked about here, there's no requirement that you do adjust your stop loss here or close out. It's just this would be the minimum required move for you to consider making that decision. Whereas if you're just scalping, then you're just out here. There's no adjustment or anything. So if you didn't do any adjustment here, you didn't close out, you still were not stopped out, because remember, our initial stop loss is based on these levels, not a price. So if you did not make any stop loss adjustment here and you did not close out, then you're still in the trade. And here at 1242 it hits R2. That's a two-level minimum move for a regular trade, and the two-level move is considered the ideal minimum level move, whereas the 1.5 is the absolute minimum required amount. The 66.95 call on the candle close is $40.76, so that's $1,876 profit per option. The 67.05 call on the candle close, $31.69, so that's $1,619 profit per option. The 67.15 call on the candle close is $21.20, so that is $1,050 profit per option on that particular one. Now, I mentioned early on in the video about the YDH, YDC, PMH, PML, and YDL levels that can come into play perhaps after a certain amount of levels have been exceeded in your favor on a certain type of trade. So that certain type of trade is the regular trade. And in this case, in this particular session, we have the YDH level that is in between the mid level, which would normally be your next waypoint after this R2 level. And so this is another decision making point here. The YDH level is the previous day's RTH session high. So this is a very important level here. Lots of times you'll see, just like we saw initially with the pre-market high here, that once it initially hits, a lot of times it will back off, and in a lot of cases it will start reversing for the entire session after that. In this case, it did not do that. It basically broke above it and then tested it again, stayed above it, and then at the end of the day ended up closing below it. But it did stay above it, elevated above it. It never reached the mid level above it, but in this case it did not only touch it but close above it and stay above it. So the point is that because this is already, because the YDH level is beyond the minimum 1.5 level move, it then becomes another level in play for decision making. So if one of these other levels is beyond the 1.5 level move in your favor, then you would also consider these as additional waypoints for decision making in addition to the main levels. So in this case, at 1:38 p.m., this candle hits the YDH. So on a regular trade, you would have, since this YDH level is beyond the minimum 1.5 level move in your favor, this would be another decision point of which to close out or adjust your stop loss or scale out as you had before. On the candle close here, on this 138 candle, the 66.95 call on the candle close was $50.65. So that's a $2,865 profit per option. The 67.05 out of the money call on the candle close was $39.57, which is $2,407 profit per option. And the 67.15 furthest out of the money call on the candle close, $29.87. So that's $1,917 profit per option. Okay, so at this time we're going to pause the video and then we're going to wrap it up by looking at the thinkorswim charts for the three different options. Okay, so first we'll look at the 66.95. That was the at the money option, taking the bullish trade from the bull bear KPO level. That was 66.95.01. Here is the 9:30 a.m. Candle close. This is also on a 2-minute chart. So you can see here, close 22. Here's the 938 scalp, which you had the wick here, which you may not be able to see from this particular line being on top of it. But as you can see here, the high was 27.2 on that wick on the touch of R1. However, it backed off, as you may remember, off of R1 in the pre-market high, and then it closed at 26. Here is the 1.5 level move, 9:44 a.m. close 32.34. Here is where it hits the R2 level, the 2-level move, close 40.76 at 12:42. Here's the 1:38 p.m. where it did hit YDH, close $50.65. Now we'll look at the 67.05. Here's the 67.05, 9:30 a.m. entry candle, close right here. Here's the 9:38 candle. Remember, this is the scalp high touch, the wick, $20.20, close after backing off $19. Here's the minimum 1.5 level move, 9:44, close $24.70. Here's the 12:42. On the R2 hit, 2-level move, close 31.69. Here's the 1:38 p.m. hit of YDH, close 39.57. Next, we'll look at the 67.15, which was the furthest out of the money. Okay, here's the 67.15, the furthest out of the money. As you can see on the 9:30 a.m. entry, closed $10.70. Here is the R1 move, the one level move scalp. High on that on the wick touch of R1 was 14 after it backed off, closed at 13. Here is the 1.5 level move for the regular trade, 944, closed $17.70. Here is the R2 hit, the 2-level move, 12:42 p.m., $21.20. Here is the 138 candle close, $29.87. This is when it hit YDH. Alright, so back to the main chart again. So we'll just close out the video here by saying, again, if you have an interest in this indicator, send us an email at daytradinggps@gmail.com. In return for you taking your valuable time to watch the video today, you can request a discount promo code that will give you a substantial discount off of the regular price by simply sending us the email requesting the promo code for the indicator, and we will send it to you. And also take a look at the other videos that are in the description underneath this video of the other different topics that I talked about earlier. And we thank you again for watching this video. If you liked the video, please like the video. It helps us with the YouTube algorithm. And if you'd like to see more videos in the future, please subscribe to our channel and you'll be instantly notified when we come out with new videos. So thank you again for taking your time to watch this video today, and we wish you much prosperity in all your future trading endeavors. Thank you.